Okay, good morning. I can see we're a good number on the call already. So thank you so much for joining us. My name is Wendy, and we are currently live in Nairobi. It is currently 10:05 in Nairobi, and thank you so much for joining us. I know we have a few people from South Africa, from Nigeria, from Somalia, from the US, and thank you so much for making the time to join us today. We are currently at the Sandbox. We are based in Kilimani at CMS Africa House, and I just want to chat a little bit about the Sandbox, what we do at the Sandbox. And ideally at the Sandbox, we're an aggregator of business professionals. So what we do, we bring together people who support entrepreneurs, and we call them experts here at the Sandbox. So what the experts do is that they work towards serving entrepreneurs, especially SMEs. So that is what they do. And today's session is actually being led by a few of our experts. And before I do that, when we say experts, we mean that we have over 35 professions based here at the Sandbox. So from business strategy, tax, marketing strategy, process and quality, team dynamics, events, photography, insurance, they're all based here at the Sandbox. So when we say we are a one-stop shop, this is what we mean. When you walk in, you find us, you find all of them here. Think of when we used to go walk around the whole Nairobi looking for a consultant to actually help us and support us in our businesses. Now it is all in one place. We like saying we are a one-stop shop for entrepreneur solutions. And we pride ourselves by saying that we are helping entrepreneurs build sustainable and scalable businesses. So mine is to say, feel free to visit us at the Sandbox. We are based at CMS Africa House in Kilimani on the ground floor. You can always call us or text us. We're always happy to, or email us at karibu@sandboxvillage.com. So I want to introduce the panel that I have with me today. And the panel I have with me today, even before the panel, the engine that is the people that are leading this initiative today. And I want to start with Thomas. Thomas is a banking expert. I don't think I ever heard of someone who is a banking expert until I met Thomas, and until I met Michael, sorry. And what Michael does is that he actually used to work in a bank before he actually said it's time to actually go help people to get resources from the bank. So I want Michael to introduce himself, just say hi to us, and what should we expect from the session today?
Thank you very much, Wendy, for that elaborate introduction. Good morning, everyone. Karibuni sana. Those ones who are in the diaspora, thank you for joining in. My name is Michael Kirui. I'm the founder and lead consultant at Hatua Peak Consulting with over 17 years banking experience. So over the years, I've been on the other side of the table listening to and actually appraising SMEs and individuals to get loans. So now that I'm not saddled with the responsibility of advocating for the bank, I want to be your advocate, to tell you, to give you a glance what is being cooked in the kitchen, because sometimes the meal that is being prepared, which is very key and fundamental to you, you don't know the ingredients that go into it. So hopefully, after this series of conversations, you'll have a better understanding of what banks actually look for when they ask you for those very many documents and the bureaucracies that go around it. So thank you very much. Looking forward to the conversation. Back to you, Wendy.
Thank you so much, Michael. And I love that you use the kitchen analogy of what is cooking. I think that's an analogy that everyone now understands. So it makes it easy for what is ahead of us for this session. The next person I'd like to introduce is Thomas. And Thomas is a seasoned finance executive with over 25 years experience supporting SMEs across accounting, financial management, reporting, internal controls, and system automation. So even for this discussion, basically what Thomas's job is to do is to make sure that you have your records right. Again, we are not running as they want. They need some form of structure, and that is what Thomas does. He is he's a co-founder of Probity Consult, where he advises small and medium-sized businesses on financial governance, financial transformation, compliance, and building high-performance finance solutions. I don't know what high-performance finance solutions is. So maybe before anything, Thomas, maybe you can let us know, what is a high-performing finance solution?
Thank you, Wendy, for that and great introduction. Today, we will be looking at when, like Michael alluded to, the cooking is happening in the kitchen, basically as the ingredients go in. Then we'll talk about what goes in first and what comes in after, so that then our recipe then works right. and we have the outcome that we need. Now, when we talk about high-performing finance operations or finance solutions, we are basically talking about creating an accounting system or a finance system within your business or your organization that then enables you to achieve the goals that are desired. So you will not be doing keeping records or doing accounting and bookkeeping for the tax authorities only. You will not be doing that just for the lenders, but just creating information that will help you as a business owner make more informed and better decisions about your business. Then your business will be able to fire on all cylinders. That's what high performance looks like.
I love that high performance, even in money, like, even in a business, high performance is still a standard. So the next person I want to actually introduce is Duncan. And Duncan is a tax expert actually here at Sandbox. But beyond that, CPA Duncan Munyasi is a certified public accountant with extensive experience in working with SMEs. He is practical and solution-driven in his approach, supporting business to build strong financial foundations. His top skills in accounting, tax advisory, financial reporting, and business advisory. So Duncan, just for you to introduce yourself as well, I would like to know, what is one thing that constitutes of a what if you were to tell an entrepreneur what is a strong financial foundation as well?
Okay, thank you for the introduction, Wendy. Though I just need to correct you a little bit. I'm the audit expert, I'm not the tax expert at Sandbox. Yes, so yes, Wendy?
Yes, no, carry on.
Okay, thank you. Yes, so like I said, I'm the audit expert at Sandbox with over 25 years experience handling SMEs and non-government organizations and all sorts of entities. Yeah. So back to your question, Wendy. So today we'll be looking at why audit and why it is important. And we'll just be looking at the kind of environment you need to have in place for your business to ensure that you have credible audit statements. Yeah, and I look forward to a very engaging conversation today. Thank you so much.
Okay, thank you so much, Duncan. Thank you so much. And next, I would like to introduce Simon. So Simon is the actual tax expert at the Sandbox. And when we think tax, we think KRA. When we think tax, we're like, oh my God, KRA is back again. But I'm hoping Simon can unpack that for us a little bit. But Simon is a seasoned tax consultant with over 7 years experience working with SMEs. He is strategic and solution-oriented in his approach with top skills in tax advisory, regulatory compliance, financial optimization, and business strategy. He is director of tax and regulatory services at Coplight, where he specializes in resolving complex tax challenges and implementing tax efficient strategies to help businesses achieve financial success. So Simon, I'd like to ask, what is an example of a tax efficient strategy? When businesses think tax efficient strategies, what are they thinking? What should they be thinking about?
Thank you, Wendy. For the and maybe your question. The strategy number one when it comes to tax is about meeting timelines and not always rushing at the end date or at the deadline. So that is usually the first factor we check out to see if indeed you are doing your tax planning very well. Of course, there are many others, and perhaps I will also be taking you through that in course of this webinar. And like you said, I'm the tax expert here at Sandbox, and what an interesting time to, have this conversation, especially like right now when finance bill is all over in the air. Perhaps we'll also be touching some few bits on that. But today we'll be focusing mostly on how you can be ready tax-wise that is credit readiness in as much as tax is concerned. That's our main focus for now. So thank you.
Okay, thank you so much. Thank you so much, Simon. So I know we're missing a few people. That's Doreen and Kenan, and Doreen is an investor readiness expert, and Kenan is our wealth and investments expert, and they'll join us shortly along the call. So this webinar is a three-part series. So last week we covered the rejection reality, and Michael and the team actually shared that 75% of businesses actually get rejected for loans. 75% is a big number, and there is stages, and even that 25, there is stages to how you actually get the loan, and there are reasons why you actually get rejected. But this session has 3 outcomes for business to understand, for you to have a business that lenders and investors say yes to. So you move from the no to the yes. So you find that some of the reasons why you get rejected as a business owner include, number one, commingling of funds. I think that's something I learned the other day, whereby you mix your money, your personal money and your business money, or you're taking money from the business to actually do other things. For example, pay school fees, go out to, entertain people. And it is valid, and when your BD person comes and asks you, I want to go and entertain somebody, you need to actually justify for it, but you can't be, paying bills in the club with business money. So it is really important for the bank to actually see that this is how your business actually works, and what actually lenders think about you, your credibility, your character. So when we say credibility comes in different ways, including your credit credibility. So it means, are you listed on the CRB? Are you aware that even digital loans can actually make you be listed on the CRB and you can't get a loan? When your financial records, what do your financial records look like? Like, as Thomas mentioned, do you actually have paperwork for your business? Like, in terms of, do you record expenses for what happens? If it means compliance with KRA, are you paying your fees on time? Do you have a tax compliance certificate? And I think Simon spoke to it last week, where does it mean that because I have a tax compliance, it means I am good to go in the loan front, or what does that actually mean? So I think for today's session, they will be covering that. So what does it mean? Like, now next, what have I... So the financial foundation and governance, and that's why you had me ask them, what is a proper financial foundation, building the records, cash flow evidence. And I think last week they also mentioned that you can't have been paid 100K today, and in the next 2 hours, you've already cleaned it off the account. So the account now has 96 shillings. So, when someone is looking at you, I don't think I trust you. And there are structures that the business, that lenders need to see. And when we say lenders, we don't mean banks only, including alternative financing, because alternative financing is also a thing. Is it debt? Is it debt equity? Is it a grant? Is it like, someone wants to invest in your business? They'll also look for more. So I think Doreen last week also mentioned that if you think getting money from a bank is hard, try getting money from an investor. It is even harder. And I'm sure she will join us somewhere along the way, just for us to unpack some of these things. So mine is just to say, please, if you have any questions, please utilize the chat feature. Please utilize the chat feature, and let's make sure that we learn the most out of this session. I want to hand over to Michael, who will take us through what today is for. And, I'm curious. I'm also a learner. I'm not a business owner, but I'm a learner. And maybe I'm aspiring to be a business owner one day, but for now I am a learner, and I'm trying to also learn for myself, and to go tell other people, hey, I think this is what we should be doing if we want to actually acquire loans, alternative financing. So over to you, Michael.
Thank you very much, Wendy, for that introduction and a recap of last week's session. So I'll start the same way I started last week's session. For any lending to happen, there must be signals that are verifiable. And in the way that individuals have a payslip, for businesses, we require records, because those records tell the lender the health of the business. So last week, having talked about the reasons for rejection, and as you had mentioned, Wendy, 67% of businesses do not have those records. And when we did a poll last week, we asked the audience who were listening, how many of them, if they intended to see their lender next week, they would have the records on hand. And that number was actually confirmed by the audience who was there last week. I don't know how better the audience today would fare, but
I think we can just ask, if you were to take a loan today, I'm curious, even for you, Michael, if you were to take a loan today, if you were to ask for a loan today from a bank, would you be given the loan based off your records? Even for you?
Debatable. Surprisingly,
Debatable.
Yes. So it's actually good to find out from the audience. Do you have your records? Are they audited? Are they in place?
Okay, it's going up in a few minutes. Do you have, are we asking, do you have records for your business?
Yes.
And it's
Because,
interesting.
Yes, Wendy, carry on.
It's interesting when you say records. I think last week we also spoke about records and what are actually records. You know, there are guys who actually just write in a notebook, I paid Juguna this money, I paid Atieno this money, I paid Moses this money. Are those records?
Once again, I go back to verifiable. Have they been verified, or can they be authenticated? Because once again, I'll go to the individual. A payslip is something we can verify and authenticate. So that's why we need experts like an accountant, an auditor, because those records need to be audited. So they need to be independently. So outside of you, who else believes this record? So if you have a notebook, it's all well and good, but does it match with the statements? And that's why the banks more often than not ask for bank statements, because those are independent records. So it's very important. It'll be part of the discussions that we have today. And I've spoken about records, and the accounting expert Thomas and Duncan will speak in depth about what those are and what is required in each of them and the process of getting each of them. Then we shall look also at bank statements. Bank statements tell a story, and they tell a story of your habits. And one of the habits that we want to see, let me not say we, because now I'm sitting on the other side of the table. What banks, force of habit, what banks are looking to see is that these records that you've presented, can they be corroborated by what is happening in your statements? And you mentioned something like commingling of funds. Do you have proper structures such that you and the business are separated? Because it's the business we are lending to, and that will speak to the governance aspect of the business and how you're registered. Because if you, like, to use the example that you gave, if you are paid 100,000 and you withdraw 100,000 immediately, then the bank will ask itself, if we present you with a loan tomorrow, will the funds be available on the 30th or when the due date is there for the bank to recover its money? So it speaks to your character. So can we trust you that you will not withdraw all the money, because there are no other mechanisms through which the bank can recover its funds? Then we shall also talk about the cash flow. What are cash flows? What is a debt service coverage ratio? Because the cash flows are the money that are available to the business. And then now, as Simon had alluded, a very important and sometimes very little attention is given to it, the compliance bit, and which also speaks to the character and the capability of the business. So that, in a nutshell, is what we'll be talking about today. So Wendy.
Okay. Hey, I'm curious. I love that now you're on this other side of the table. So even you're not sure if you can qualify for a loan. I love that you're not the judge and the judge, like, you are one of us, for lack of a better term. And I can see on the poll, I see actually 53% don't have verifiable records for their businesses. I think that's a red flag. That's a very big one. But I'm sure
it's an improvement.
It's an improvement from last week.
An improvement from last week. So there's hope for us.
So there's hope. So I think even this 53%, I think this is their time. Like, you need to actually seek services of the experts here, just so that they can also help you put in the structures that we're about to talk about today. Because I think that is the essence of it, or it's just the structures. And I think over to you, Michael, now.
Okay, great. So fundamentally, there are 4 levels, because the more verifiable the information you have, the lesser the risk, and the higher the amounts that you can qualify for. Because you realize, and last week I said this, all lending is risk-based. So in as much as people say that the bank is in the business of money, it's also in the business of risk. And this risk has implications internally, both to the employees and to the shareholders. So they have to put in place measures to mitigate those risks. And the more verifiable your risks, your documents are, the better they are able to understand your business and therefore take a chance on you, the business owner. So you are the dreamer, you believe in your business. You actually know without any shadow of doubt that if the bank gives you the money, you will be able to repay it back. And to use the analogy of a marriage, giving you the money is actually the wedding day. The marriage comes in when now you start repaying. So how will it end on the other side? Will you have a harmonious marriage devoid of any issues, understanding, and proper communication? Or somewhere down the line, someone will have issues and want to opt out. And opting out for the case of the bank is you are unable to pay. Sometimes for you, it's you are paying off the loan and moving to a different lender, and that's why security is needed. But for the purposes of this conversation, I'll start with, if you're a business with no records, you don't have records. So I'm speaking to the 47% who perhaps do not have.
It's actually gone up to 58% now. So 58% don't have records, because I still have the poll running, because for this session, it's more about the records are what are most important. So the poll will run as we keep the conversation going.
Okay, so for the 58% of you, so if you have no records, it's somewhere, it's not been audited, you have cash transactions only. So like I mentioned, your risk is high. So therefore it means you'll have low access to credit. So what that does is the need for credit doesn't disappear because you don't have records. So that's where now SMEs are forced to go to informal lenders, and here, which are characterized by higher interest rates. And this is one of the causes of failures in business, because if you are getting lending north of 20, 30%, then you are taking a chance that your returns will be able to cover this and to cover the loan repayments and also sustain the business. So it drives you into a very precarious position. So you are at the mercy of predatory lenders. So then you move to the next people who, and I am assuming none of the attendees here are in the first category where there are no records, it's only cash transactions. So here is where they will depend mostly on M-Pesa statements and their bank statements. But if you have maybe sales and expense records, yes, there is some level of entry, but this also now gets you to the digital lenders, because of course, you'll have daily and weekly sales book and receipts. You'll have invoices from suppliers. There's a rudimentary mode of keeping some sort of records. So that one now starts opening you up to M-Shwari and Fuliza and business and SACCO loans. If you are there, that is the only access that you have available, because once again, the risk has reduced slightly, but it still doesn't meet the threshold which the bank requires. And the bank has what is called a credit policy, and that's the playbook which they use to determine how much you can get. So that once you move it further, and here there are management accounts, and Thomas and Duncan will speak to what are management accounts. So it's what now, it's the basic entry point to what kind of facilities that you can access. Maybe you want asset financing, where you want to buy a vehicle to help you with the transportation or a particular machine, and that machine is used as security. So you management accounts are sufficient for such kind of borrowing. And the limits now start opening up for you. So you can access it for between 500,000 to about 5 million. So let's say you want to buy a truck to help you in transportation, or you have a machine that maybe is processing whatever it is that you're doing. This is, you can unlock this level of lending from formal lenders now. And the highest level where now we want to take everyone, or by the end of this discussion, at least the aspiration is to get to, is audited financial statements. So here is where you have income statements, balance sheets, notes prepared by a CPA such as Thomas, and audited. And auditing means you have an unqualified, and this is the one Wendy was struggling to understand, the difference between a qualified and an unqualified statement, audit report. So if all the documentation is proper and they are audited with an unqualified report by the auditor, then now you are able to unlock the full bouquet. But also it's dependent on what the needs of your business are. So in a nutshell, that's the ladder that you have to go through from no records to the highest level where you have audited financial statements. Once again, it's about verifiability of the information that you're providing. So with that, I think it would be a good time to look at the poll first, and then I invite Thomas and Duncan, who will walk us through the different documents and the process of getting them. So back to you, Wendy.
Okay, so we have 63% have said no, they don't have verifiable business records, and 36% said yes, I actually do have verifiable.
If you remember the number I'd said 67%. So we are getting to where I was saying.
It's not so far off.
It's not so far
off. Yes. So I think we'll just bring on Thomas and Duncan just for I think this is Thomas. So maybe just Thomas, just to ask a fairly simple question. Is an Excel sheet enough to actually give me a loan from a bank? Like, I'm tracking my expenses on an Excel sheet. Like, let's say for 2026, it means that every month I have an Excel sheet that shows my expenses. I paid Salos, like I'm just tracking it on an Excel sheet. Is that enough?
It's a start point. It's not enough to get you that loan, but it's a start point of the records. And we will talk about that and basically help you see how that Excel sheet can be enhanced to actually get you to the place where you'd have what we call management accounts, which then should be able to get you on the right steps of getting this loan or lending from the bank. So many businesses, Wendy, many business owners look at accounting or bookkeeping as something done for the tax authorities or for people who would like to look at certain information at certain times. And then they also look at it as something that only the accountants understand and they would not understand. And today, let's demystify that, because in reality, accounting is simply a structured way of tracking your business's money. It's simple as that. Money that comes into the business goes out of the business. How do you track it? That structure is what accounting brings into the business. So you will be able to know whether you're making a profit, whether you have control of the cash that is coming in and going out, whether you are making any losses, whether you have the right amount of taxes, whether you're calculating the right amount of taxes and therefore paying the right amount of taxes, not overpaying or underpaying. And then, as we are talking today, access to loans and investors. This is the thing. So when we talk about accounting steps, we are basically talking about different things we do. So the first place is recording transactions. And when we talk about recording transactions, this is where you, as a business owner, are actually able to do certain things. So here you need to be able to identify transactions in your business. And we say every money coming in of the business and going out involves a transaction. And therefore, you must be able to identify that transaction. It could be things like you're purchasing stock. You could actually be paying wages or salaries. You could be paying, receiving money from a customer. You could be lending money to your own business to be able to do something. You could be receiving a loan. So you've applied for a loan, it's come through. Or you could basically be doing things. So those are the different things that actually we call business transactions. And you need to be able to identify this. record them in whatever format or way that you're able to, and this needs to happen on an ongoing basis. So Wendy, yes, the spreadsheet is valid, and this is where it would come in, where you would start doing this basic kind of recording of transactions. So once you've identified the transactions, you have recorded these transactions in a format that you're able to actually understand what they are, or you can explain by basically seeing them, you can remember what happened. It is key that then you also have some documentary evidence towards them. So like a receipt, if you purchased something from a supplier, you record the transaction, but you keep a receipt separately of what they issued you for the purchase. And you just have some supporting evidence, we call it, towards that transaction. So once you're done with that first phase of identifying transactions and recording them, then we move into a second category. And this is now where your accountant or bookkeeper comes in and will be able to help you. And this is where now we can actually categorize transactions. So all you've done now is you've listed all your transactions, what you've sold, what you've paid out for, and everything is documented. So your accountant or bookkeeper would be able to come in and start categorizing these transactions. And these categories would be identifying items that would relate to income, money coming into the business from what you sell, your goods or your services, and expenses. Those are the two broad categories that we would be looking at. So what expenses have you incurred? And we would categorize them into different kind of expenses. That'd be what would be like your cost of sales. What did you actually sell and what did it cost you? Then there's operational and administrative expenses, the rent that you're paying, the internet for your business, the salaries and the wages that you're paying out, and the different things that you're doing. So the accountant will be able to categorize all this and then be able to come up with a good summary of those transactions to help us understand the different things that we have done and within the business and what those transactions then mean for the business. So after we summarize them, there is something that then needs to go into those records, some adjustments, and because accounting is done based again on policies and standards. So there's certain accounting policies that the accountant needs to apply to those records to ensure that they are compliant, so that when different people look at the same information, they can interpret it in exactly the same way, so that the understanding is the same. So there's some adjustments that then need to be done, and this an accountant now would do. And some of these adjustments is because the records that you've been keeping as a business owner mainly will be about cash that came in and cash that went out. However, there's expenditure we incur in a business and we have not yet paid. Basically, businesses advance credit by suppliers, and businesses also advance credit to their customers. So where transactions have taken place and transpired, but cash has not yet exchanged place, that's where the accountant comes in and now identifies such kind of transactions and brings them in so that then the records can be complete and accurate. They can paint the actual picture of how the business then is performing. So the accountant then will perform the adjustment of those records, and then we'll come up with a listing, which then we call a trial balance. And a trial balance is basically a listing of all those transactions categorized into different elements of accounts or expenses and incomes that will help us identify the transactions where cash has been transacted and cash has moved in and out, and even those transactions that have transpired but cash has not yet moved. So we can basically bring in debtors and we can bring in creditors into the books. Now, once all this is done, then the accountant will be able to prepare a set of financial statements, or what we've been alluding to as management accounts for the period. And the period here generally would be a month. Now, these management accounts we talk about, they generally comprise of certain key records or statements. One is a profit and loss account. And this is an account that basically shows the dealings, the sales and the expenses of the business, and what the net impact of that is. Is there a loss that has been made in the period, or is there a profit? So it basically tracks revenues or incomes and expenses that a business has incurred in a period. The other set of statement that a business would also, the accountant would also produce for the period is what we call a balance sheet or a statement of financial position. Now, this is a listing of all the assets and the liabilities of a business, what a business owns and what it owes to others, and how does that balance out. So it will list things like balances in the bank, inventory or stock that the business is holding, the debtors, customers who owe the business money, and all those are assets, and any other assets, fixed assets that could be there within the business. But it would also then list out the liabilities. And examples of liabilities would be amounts that are owed to suppliers. Maybe there's some amounts that are owed to workers and staff that have not yet been paid out. Those will be listed there. Maybe there's some taxes that the business has incurred but has not yet paid out to the revenue authority. Now, those would also be listed there. But also key in that part of liabilities is what the business owes its owners or the capital that they have actually put into the business. So it tracks that, and it actually shows it in that statement. And then a third statement that would normally also be there within those management accounts is what we call a cash flow statement. And a cash flow statement seeks to explain the sources of money that came into a business and how that money then went out and what the money then was used to do for the business. So it will indicate money that came in from operations or sales, money that came in, maybe the business sold an asset that it had an old car that they were using and they needed to buy a new one. So when they sell the old car, the money came in, so it would record that, then it would record where money went out. So payments to suppliers, payments to workers or staff, maybe payments to the owners of the business, a dividend was paid or something like that, payments to tax authorities. And then it would actually show how much then of that money is still within the business, sitting in the bank account. So that's a cash flow statement. It helps us then, or users, identify where money in a business came from and where money went to when it was used. So with the close of that, then we'd close the period, and then we'd have that as a set of financial statements, which then even business owners can use now to track and see what's happening in the business and even make better financial decisions around that. I think before we close this off, I'd like to invite Duncan to talk to us about auditing. And once we prepare financial statements, why aren't these just necessarily enough as they are? What is auditing and why? Duncan?
Thank you so much, Thomas, for taking us through all the steps from recording transactions up to, all the way up to preparing financial statements. Now, like Michael had mentioned in the introduction, that you'll need to have your accounts, or rather the books, audited by a qualified auditor. In Kenya, we are regulated by the Institute of Certified Public Accountants. So you have to ensure that the auditor who comes to audit your books, they are registered with the Institute of Certified Public Accountants. Then just to add on what Thomas has said, apart from the profit and loss balance sheet, data summary, creditor summary, cash flow statements, there are also other two reports which may not necessarily be generated by the business, but they'll form part of the audited financial statements. Now, the first one is called a statement of changes in equity, which shows the share capital, and also, let's say, if the company made a profit or loss, then how much does that money belong to? How much money belongs to the owners of the business? Then, to support each of these other reports which Thomas has talked about, we'll also need notes to the financial statements, and these have to be audited also. For example, if you are saying that your bank balance is, let's say, 500,000 shillings, you need to provide a breakdown. Let's say you have several bank accounts and you also have several M-Pesa accounts. So in your balance sheet, it may appear as one figure, but the note supporting that particular item will need to provide a breakdown of what all those balances consist of. So once you have your financial statements ready, the auditor comes in. And why is it important for SMEs to have audits? Now, we have mentioned the 3 items on the slide there. That is credibility for third parties, confirming accuracy and compliance, and also improving financial management. I'll just talk a bit into that. Financial audits for SMEs in Kenya are crucial for ensuring regulatory compliance with the Kenya Revenue Authority and the Companies Act 2015, securing funding and improving operational efficiency. Once you do an audit, it builds trust with investors and banks by validating financial accuracy. And Michael had mentioned earlier about validation of financial documents. Audits also help in reducing fraud, risk, and also providing strategic insight to foster sustainable growth in Kenya's competitive market. So the key benefits of auditing financial statements is, the first one is statutory compliance, which ensures that there is adherence to Kenya tax laws and regulations, and it helps the business in reducing things like penalties and such. Then, like we've mentioned throughout this webinar, access to financing is also one of the reasons why it's important to have audited financial statements. So the audited reports are typically required by banks and financial institutions in Kenya when processing business loans, not just in Kenya, worldwide. I believe in many countries. I happen to have worked in many countries, and I know that is usually the requirement. Another benefit of auditing financial statements is that it helps in risk management and fraud prevention. It helps the organization identify internal control gaps and prevents fraud, which is crucial for protecting the business assets. Remember, as a business owner, you need to protect your assets. Then there is credibility with stakeholders. It builds confidence among investors, creditors, and business partners, just to be sure that there is that confidence there. It also helps in decision-making by providing accurate audited data that allows business owners to make informed decisions about growth and efficiency within their business. Also, operational efficiency, whereby it highlights weaknesses in financial processes, allowing for improved efficiency. So just to mention that once the auditor prepares the financial statements and issues them, there is another report that they'll issue apart from the financial statement, which is called a management letter, which basically details the weaknesses that may have been encountered during the audit, and it will highlight the risks and also give recommendations on how to go about those weaknesses that have been identified. So finally, I'll summarize with the steps that one needs to go through in preparing for audit. So like Thomas has mentioned, you need to organize all your financial records, including the balance sheet and cash flow statements. Then once you're preparing those, you need to ensure that you adhere to the various accounting laws. Like in Kenya, we use the International Financial Reporting Standards for small and micro medium enterprises. So you have to ensure that you adhere to those. Then finally, in any business, you need to establish strong internal controls and maintain open communication with the auditor. So if there are anything that maybe it's happening in your business and you have not mentioned it to the auditor, then that will cause a problem in that sometimes, let me give you an example. Let's say you have a bank account, but you do not want to disclose it to the auditor. Let's say later on, Central Bank of Kenya flags it. Then the auditor will not be responsible because you'll not have disclosed that kind of bank statement, and it will probably not form part of the accounts. So I'll take it.
I have a few questions, and this goes back to Thomas as well. I'm seeing there's a lot of documentation that is needed, like literally, because I was writing, so I can see like a P&L, a balance sheet, a data summary, a credit summary, a cash flow statement, a statement of changes in equity. Like there's a lot of small things that are actually needed. Can a bank flag you if you have money that is owed to you? Like they look at, because I think they look at all these documents that you have actually mentioned, and they see, I think it's a debtor's summary or creditor summary. I don't know which one it is. You'll clarify for us. But if you have too many people owing you money, can a bank flag you and say, I'm sorry, you're a bit of a high risk, I can't give you money?
Wendy.
Yes.
Let me jump in briefly, and I know Thomas wants to speak to it.
Yes.
If it sees that, then that is one of the reasons why you came to the bank initially. Because if there's a slowdown in collection, that creates a need for you now to get funding. So in and of itself, it is one of the causes for borrowing. So it's not a bad thing. It's actually one of the reasons that would take you to get financing. Thomas, I know you want to jump in.
Yes, I want to just speak into that a little. When we basically talk about financial ratios, we look at relationships of different things. So yes, the data statement is what would be the list of the customers that owe the business money. Now, if this number is getting too high, it means that also rather than also just borrowing is one of the interventions you can do to bridge the cash flow gap. However, you need to be able to put in adequate more measures to be able to collect quicker. Because when debts remain uncollected for a while, they start breeding bad debts. And you may need to start writing off some of those debts down the road. Duncan would also mention that. You need to make provisions. So if you have very high amounts of debts that have not been paid, yes, a bank, that would be reason to take you to the bank to borrow. But the bank may also look at that as a risk because they may lend you money to help you sell more, and then you still don't collect that money and make repayment to them. So you need to have mechanisms for collection.
Is this where you involve a debt collector or like auctioneers or something like that? Like, is this the part where you decide, okay, I'm so tired of following people with this money. Do I involve a lawyer, an auctioneer, a debt collector? You know, is this the part where let's say like even the debt that is owed to me is bigger than what I'm even making in profits?
Wow. We hope it doesn't get there, but if it does, I think, and that's why accounting records are important, because if you keep your accounting records regularly, you will be able to actually identify customers who are not paying you in the intended time early enough. So you can begin putting in enforcement mechanisms internally first, before now you go for outside interventions. By the time you go to auctioneers, by the time you're getting courts to intervene, it's usually very late in the day. And by then, a lot of that debt is lost and may not be paid by those customers. So regular record keeping and having accounts that then you can interpret and then make informed decisions will help you also collect faster.
Okay, there's a poll running on the side just for has your business been audited before? So I'd like us to just respond, like, has your business been audited before? I'm curious. I'm seeing so far it's 100% of people who said their business have been audited. So we'll keep looking at it. I don't know, Dan, can you have something else to add?
Just to add on the previous question he had asked.
Yes.
You may have a lot of money uncollected. That would mean that you have a strong balance sheet, but most of your money is in debtors. So you'll have issues in running day-to-day operations because you don't have cash. Yes, your balance sheet shows that you have strong debtors, in a strong debtors position, but you're not able to service your day-to-day operations. Now, again, remember, the law, or rather, accounting principles allow you to provide for bad debts. But I know Simon might talk about this later when it comes to taxes. KRA will not just allow you to put any figure as bad debts, because remember, it affects your profit and loss account. It's a loss. I mean, it's an expense, sorry. And therefore, they would expect you to do everything possible to collect debts. So yes, some of those things that KRA would expect you to do is to go as far as even taking legal proceedings against your debtors who are unable to pay on time. And I believe Simon will talk about that.
Okay, so I'm just looking at the poll questions here for have you been audited before? Because it seems like that's a big thing. And I'm seeing 60% are saying yes, they have been audited. 40% are saying no, they have not been audited. I'm curious, maybe Duncan, this one is for you. Why do most businesses, why don't they get audited, or why are they so hesitant about being audited?
Okay, thank you so much, Wendy. In Kenya, there is a threshold under the Companies Act. Businesses, once they reach a certain threshold in turnover, in assets, and in employees, then they're required to, it's mandatory for them to be audited. But if a business has not reached those thresholds, still there are benefits which an organization can derive from by being audited, even though they may not have met the thresholds as stated in the Companies Act of 2015.
Okay, so I'm looking at the questions that we had for the people who registered for the webinar, and a big question comes, and this goes back to Michael, a big question comes around the processes that it takes for the bank to actually approve a loan. And I think a lot of the guys who are on the call today didn't attend session one where you were telling us that mambo ni mengi, like, when you're applying for the loan, there's a lot going on. So I think just the clarity around why sometimes it takes long, what is the time period of how long it actually takes for you to be approved or not to be approved, and what happens next. Maybe Michael, just give us a small recap now that you're coming from the inside, coming outside, you have some more insights into actually the processes around the applications, because I know we've talked about the documentations, what is needed, and Thomas has actually mentioned that this is what the bank will look for: a P&L, a balance sheet, a debtors and credit summary, changes in equity, cash flow statement. So even after I've given you all these papers, why does it take so long?
Thank you, Andy. And that is the common frustration that goes in. You see, the financials is just one aspect that the bank looks at. And let me just say it for the avoidance of doubt, it's the easiest part. The numbers are either there or they are not there. So it takes less than 72 hours for the numbers to be crunched and the decision to be made. But remember, I said that's just one aspect. That's the quantitative aspect of giving you a loan. There is the qualitative. Now, do we understand your business? Does the business send the right signals? Who are your customers? You talked about debtors. If one of your customers provides 60% of your business, the bank has to ask itself, what happens tomorrow if this client cancels the contract that you have with them? There's something called concentration risk. So if one customer gives you 60% or more than 50%, let me say over 30% of the business is provided by one client, how does the bank mitigate that risk? There's another risk called key man risk. If you are running the show, no one else knows this business, the bank will ask itself, if you're incapacitated for an extended period of time, how will that affect the business? So there's the risk component that goes beyond. And in the industry that you are in, how differentiated are you? The systems you have in place, which speaks to the governance that Duncan has been mentioning. So I mentioned that there are three people who you need to balance the interests of. There's a credit analyst who will look at that document dispassionately. There are no feelings. It will be about what signals the business shows. And also let me point out that you could have the best, the accounts are in place and they are in order and they've been audited. Then there's the place of the statements, which I can see you've shared on the screen. Now, there's an allowable variance between what is shown on the management accounts and what can be gleaned off the statements. So if we are looking at sales in the management accounts and we cannot see the same in the statements, then that is a problem. So the bank has a choice of telling you, yes, we will approve, but with the condition that we need to see the sales coming in for the next 4 months or 3 months, depending on the policy of the bank. Then there is the issue of the security that you've provided. We have to verify that you are indeed the owner and the bank's interest can be taken into account when they take ownership of that. And the approval will only come once the security has been fully charged by the bank. So if you have an asset like a house, for instance, or land somewhere, and it takes 6 months or even sometimes a year, you will not see the money until that is done. I don't know if that answers your question, Wendy.
I think it does. It actually does. And I think what I'm also looking at on my screen, it's the red flags and the green flags, like what would actually build your case and what kills your businesses. And I didn't know actually that returned checks injure your ability to actually get a loan.
It does.
I'm like, so if someone pays me and I return the check and say the check bounced, it injures their business?
Not a one-off. If it consistently happens, you see, one of the things is, if it consistently happens, then it's both. The bank doesn't get too worried if someone else gives you a check and it bounces on the other, bouncing, or the correct term is unpaid. But the bank is mostly concerned if you are issuing checks when you don't have sufficient funds. So if you issue a check
of 100K to everyone, kumbe you don't have money in your account.
Yes, that speaks to your character, because the bank looks at it that you will do the same. So when the loan falls due, you will also not have sufficient funds. If you can do it to someone else, you'll also do it to the bank. Once again, it's about risk. It's about mitigating risk. Have you displayed that you can be trusted?
Okay.
Can we trust you?
Can we trust you? So trust and risk. It's a game of trust and risk.
Yes.
Okay. So there's a question around financing, but I'll read it for. Can youth-led businesses get LPO financing to supply?
And here we will talk about, when you speak about youth-led, how are you structured? Are you a SACCO? When you say youth-led, the issue of age does not come into consideration. It's, are you registered? How are you registered? Do you have experience in the business? Do you have the records? In which industry are you in? And when you say LPO, now the reputation of the organization which you are supplying to now comes into effect. If you're supplying to a multinational, then of course the credibility of that multinational is good. So the bank will be secure that once you supply, you'll get paid. But if you supply to an SME which is not known, and no disrespect to all our businesses, the bank will ask, who are they? What is their profile? And if they can't establish, once again, the key thing for banks is, can we independently verify this information? So the issue of youth doesn't come into play so much as the signals that the business shows.
Okay, so structures, number one, structures are very important. Even if age does not matter, age is just but a number, and the structures are what give you an edge into actually getting the said LPO, which I love that age is just but a number. So if you have any questions, please put them in the chat. Our experts will happily answer them. If you have any questions, comments, please put them in the chat, or use the Q&A feature to actually ask your questions, and we'll be able to pick them up and answer. So I know we have talked about our records, we have talked about what the bank wants, we have talked about after Duncan has said we need to be audited, this is what we are doing. There's a part we're not talking about, the tax collector and the person working with the tax collector to make sure you're compliant. And in this case, it would actually be Simon, who is our tax expert. But before that, I think, also there's something that before you get to the taxes, because taxes, they just want to collect, but there's also the language every lender speaks. And I think I'll let Michael for you to speak into this.
Yes. So this speaks to your ability to pay. This is your debt service coverage ratio. So based on the records that you've provided and the statements, the records, the financials and the statements, the bank starts looking at debt service coverage ratio. So your monthly inflows, are they sufficient to cover the loan repayment? So let's say your inflows, and here I've looked at 3 examples where your monthly income, the one which is normally rejected, and Thomas had spoken about ratios. So once you provided the statements and the financials, so the bank asks itself, let's say you want to buy an asset valued at 150,000, for instance, and then your monthly, let's say you want a loan of, let's say 8 million, for instance. I'm just picking a ballpark figure. And your monthly income is about 150,000. And your repayment is 140,000. So if you look at the monthly cash flows and you divide it by the loan repayment, you get what is called a debt service coverage ratio. It needs to be sufficient to pay off the loan and have something to continue running the business. Conventional wisdom, or the current practice, is 1.25, meaning that for every 1 shilling of loan repayment, you must show 1.25 of net cash. Some banks are more stringent, they go up to 1.5, just to be safe. It depends on the risk appetite of the particular bank. And this is information that the bank will not tell you, but just have it at the back of your mind that when they're looking at, can you pay this loan? That's what they're looking at. So if it falls like the first example where it's 1.07, it's too low. Even if the income looks solid, everything will go to the loan repayment. So how sustainable will the business be? Remember I said the approval is the wedding day. The marriage has to continue. So the bank has to concern itself with the loan management aspect. So if you barely have enough money to continue running the business after paying the loan, then that lending is unsustainable. So if you look at the second example where you're shown it's 200,000, then the repayment is 140, so the debt service coverage ratio is 1.4, that means we see a sufficient buffer. So the cash flow is predictable and the business can also absorb the revenue dip, because a loan repayment will be a dip on the revenue. So how will you be able to sustain them? It's just looking at, do you have a buffer? Look at it, if you look at it in the example of a household, once you pay rent, can you meet the other obligations? Or once you pay the digital loan that you have, do you have enough to pay for rent, food, school fees, transport, and all those things that have to run the home? So this is the same logic when you look at the business. So sometimes you'll get to option C, where your income is very inconsistent. It varies. So sometimes it's 80,000, sometimes it's 220,000. So now that will require a review. So the bank will approve, then they'll tell you they need 6 months of data before making a decision. It means we are not sure. We don't know where exactly to place you. Rather than say no, what we are telling you is go back, have the right disciplines. And this fundamentally is where a lot of very good business fall into, where you see huge variances. And it's because normally the bank, the financials are very okay, but when you start looking at the statements, that's where the informality comes in, where rather than banking the money, the owner decides to pick that in cash and or continue keeping it in business. So the bank cannot be able to tell. So 1 month, the bankings are 80,000, it goes to 150. We can't be able to tell where to place you. So those huge disparities, there needs to be discipline in every inflows into the business are directly channeled into the bank, so that the bank, or sometimes even M-Pesa, let me even say M-Pesa, because we know that banks are increasingly relying on M-Pesa statements. There has to be a verifiable source of repayment. And that's why this is important.
Okay, thanks, Michael. So I want us to jump into the tax part of things, which is something that I know we talked about it, but I want us to jump into the tax part of things. And I just want to ask Simon to speak to, number one, what you must have before you approach a lender and the checkpoints when it comes to tax. So Simon, I think this is over to you, just for us to give us some clarity around that.
Thank you, Wendy, for that. Yeah, so you come to realize that a business is owned by many people. One of the invisible owners of your business is the government. And actually, perhaps I would be right to say that they own a majority shareholding of your business. And therefore, when the bank is giving you money, they have to check, do you actually pay your majority shareholder? Some might say I'm not right, but if the government actually takes like 30% of your income tax, on top it takes 16% of your VAT, and if that's now about 46%, and if you have employees, then you could have about 1.5% housing levy. If you have withholding tax, then if you have NSSF you're paying on behalf of your employees, it's more than 6%. So the government actually owns you more than 50% of your business. Only that you may not see that in the CR12. And I'm sorry if you thought you are the only owner. So this actually brings now the aspect whereby the lender want to know, how are you managing this majority shareholder? If you can't be able to pay this majority shareholder, then how possible is it for you to pay back the bank their money? So that's why now the issue of tax comes in. And one of the records they have always requested is the tax compliance certificate. And like now I mentioned last time, it's usually not enough. So, and I want to take it from Michael, where he said that these documents have to be verifiable, or they have to be authenticated. So the bank actually authenticates or verifies your tax compliance to check if actually that's the right status. So having said that, I will not want to go into the details of the complex things, but I would want to just take you through these very basic requirements. Then I will also take you through the why they are needed, and I will be done. So the first one, of course, is the PIN registration. It's very basic because immediately you register your company, you definitely get a PIN immediately. So that one, I will not belabor on it. Then from there, that PIN comes with something we call income tax obligation. So with the income tax obligation, then you are supposed to file these tax returns at the end of the year. So if you haven't filed these tax returns, then it means that you are not in good terms with your majority shareholder, and that means is that you are going to reduce the probability of the government of the lender or the bank to lend you actually this money. So that's number one. So you have to safeguard that gate. Then there are those who have the VAT obligation, or those who have annual turnover of more than 5 million, of which I know a good number for here. So if you, again, you don't remit your VAT on a monthly basis, then it means that perhaps you're not even paying, because without filing, perhaps even the probability of paying becomes low. So this one, again, is also a factor of consideration for the bank. Again, if you happen to have employees on board, you have this additional obligation called the pay as you earn. So here you're supposed to deduct your employees. Actually, this is not even your tax, but the lender will be checking if the time you deduct these employees, do you actually remit that money to the government? If no, then they'll be like, if you are deducting people and you're not remitting the government, then what gives them the conviction that you're actually going to pay for the loans? So again, this one becomes very serious, because we call this agency tax, whereby it's not you who is actually being taxed. So you're just being given that opportunity by the government to deduct on their behalf. So if you're able to tick the income tax, you're able to tick VAT, you're able to tick the pay as you earn, then you automatically get this document called tax compliance certificate. However, there are some exemptions. There are some exemptions whereby you can have the tax compliance and you have not been able to tick all those boxes. And that now takes us to the slide number 2, whereby the authenticity of this tax compliance is checked. So which are these checkpoints? First is you may have the TCC, you have ticked all the boxes we've said, but the government, the lender or the bank is able to look at your filing history. Perhaps you just filed all those returns previous month because you knew next month you're going to apply for the loan. But the records are usually very clear because they are systemized. So if you've not been having a very good filing history, then the bank is likely not to give you the loan, perhaps because you filed just for compliance purposes so that you can get the loan. So that is one of the major checkpoints. Also, under this history, they check if perhaps you've been doing it on time. They know these timelines. They have their experts, their tax experts internally. They know when VAT is supposed to be filed. Perhaps every month you always file like 2 or 3 days late. Your PIN is full of penalties and interest, even if you still have the tax compliance certificate, because you can still get it even without having a good filing history. So that one will be checked. So what the message that I'm communicating right now is make sure that you are able to enhance your compliance internally as soon as you can, because you are going to need it if perhaps you need a loan in the near future. Then the second checkpoint is usually on the consistency between the tax returns and the bank statement. Now, here the issue of integrity comes in, because what people have done is that actually, in most cases, people have always filed nil returns whereas they have been in business for the longest time. However, for business owners, they don't file any returns, but they declare. You file like your bank statement is reading income worth of perhaps even 70 million, 50 million. Your declared revenue is 10 million. So the bank is able to check the declared sales vis-a-vis financial statements that Duncan has talked about and the actual bank inflows. They may not match 100%, but at least there is an expectation. You can't be receiving 20 million and you're declaring 3 million. So that one brings a lot of doubts to the lender, which might actually limit your probability of getting this loan. And finally, the final checkpoint they will check is about existing tax disputes or KRA audits. So these ones are usually very silent when it comes to a tax compliance certificate. Hence, the need to verify, like Michael had said, if actually you have these disputes. These disputes, sometimes they can be very frustrating to the business in a way that they can actually take out your cash flow if you're not very keen, because you find a dispute is going for 5 years back, and perhaps you are needed to pay a lump sum amount of maybe even over 30 million, over 40 million, and you are taking a credit. So the market will be like, if you are not able to settle this, or if this dispute does not close in your favor, then the bank is also at a crisis. They are not going to be able to collect the repayments. So this one is one of the key things they check. Currently, we are finding ourselves in a situation whereby the current finance bill is proposing that before you actually go to appeal for these disputes, you need to pay this money, and they have the power to come and collect that money as you continue with your case. So that means that if you have an existing dispute, your cash flow actually is gone. So there's no way the bank is going to give you the money. They are not going to risk their money with you. So what that means is that if you want to avoid this kind of disputes, then remember the first, right? Make sure you tick your pay as you earn, tick your income tax, tick your VAT payments. Make sure your majority shareholder is happy, is well compensated, anapata dividend zake vizuri za over 50% zenye nimewaambia, and then you'll be ready for the credit with the bank. Back to you, Andy.
Okay. Hey, me, I feel like I don't think I'm ready to be a business owner. That is number one, because mambo ni mengi. It's a lot. Like, it is a lot. It is a lot, from what is required, fighting with KRA, making sure I am moving with integrity, not under declaring. Like, it feels like a lot. But I love that it's also very simple and very straightforward, because it means that if I actually have systems and structures for my business, then I won't feel like it's a lot. I'll feel like, oh, I have the process. It is here. It is here. So I know we are just about it's 7 minutes to the end of our session, and I just want to invite our experts. Final remarks for this session, because we have really talked about compliance and foundations, and we said that our foundations, this is what is required of us. Governance is what governance looks like. So I'd like to start with Thomas, Duncan, then Simon, of what next. So what would you advise? Like, what did you tell the entrepreneur who is thinking, I want a loan, but I don't even know where to start from, or I want a loan and these processes are too many, or I want a loan, but hey, another auditor to tell my business about my business, I'm tired. What would you actually tell them? So Thomas.
Thank you, Wendy. For me, it's basically just again talking about the importance of financial records, and I think it doesn't matter where you are at. That's a place where you have to start. Just get records sorted out for your business. The foundation, just like a building, if the foundation is right, then whatever goes above it will not come crumbling down if it's done right. So get an expert to come in and just help you structure those financial records so that you do them for the sake of the business, for the sake of information to run your business better, to make more informed decisions. Now, all the other users of this information will be offshoots. There'll be third parties, and you will already have the information. It will be accurate, it will be complete, and then you will be able to fulfill a lot of those other requirements that come from the others by just having your accounting in order in your business. Thank you, Wendy.
Okay, Duncan.
Thank you, Wendy. My parting shot would be that ensure that once you have your records in place, make sure that a registered auditor comes and looks at your books. And always aim for an unqualified opinion. Then secondly, ensure that you have strong internal control systems in your business. Thank you.
Okay, I'm curious, Duncan. I've had you emphasize a lot about a registered auditor. Are you saying that there are people who actually masquerade as auditors?
Yes.
Oh my God. Oh my
Yes.
God. I thought it was just the lawyers who are masquerading. Kumbe, even the auditors are also masquerading as auditors outside here. So it's really important for you to get someone who is actually certified and registered with ISPAC.
The auditors registered with the ISPAC, and the one way you can check for that is to go to the ISPAC website, and you'll be able to see the auditors who are registered. And then secondly, just one way to curb these people who masquerade as auditors. Once the audit report has been issued, there's something called unique documents number, which you'll be able to scan on your phone and be able to tell whether that audit opinion is genuine or not.
Okay.
Yeah.
Okay. Simon, over to you.
Yeah, so I think for me, what I can say is don't complicate tax compliance. Just work with tax expert. Just work with someone who is knowledgeable in that sector. We are here, we are ready to assist. And then you can be able to focus on your business and the growth of the business. So don't complicate it, seek advice, and you'll be assisted without you having to worry about it.
Okay, thank you so much. So I have a question in the chat from Lawrence Koich, and he says, I've been struggling with level 1 of finance records for years. Moving a business from a side hustle to a structured business is a real challenge. So what would you advise? What would be, I think this question would move maybe to Michael and to Thomas. What would be your advice to Lawrence? Thomas and Michael?
Yes. I think moving a business from an informal kind of a business setup hobby to actually a formal business, this is where I mentioned foundations. Kindly get in touch with an accountant like us, or somebody who can just help you structure and come up with a system. Now, a system does not have to be costly. A system is just a way in which you will be able to record your transactions in such a way that management accounts can be produced out of them at the close of a period. So have an accountant come in and structure that for you in a way that you can run it and put in this information and be able then to start getting a feel of what is happening within your business from a financial angle. Thank you.
Okay. Okay, thank you so much, Thomas. Michael?
For me, I would build on what Thomas has said, and I'd look at it now from a lending point of view. So what I would say is that level of informality, what it does is it restricts your access to formal lending and to cheaper credit. So what I would urge you to do is to find out what the requirements are. And we've pointed out how you need to move up. So find out whether an M-Pesa statement is sufficient for certain kinds of borrowing, but just be aware that it will limit, without the structures and the foundation that Thomas has mentioned, it will limit the access that you have, And also, the cost of credit for you will be relatively higher. That's how I'd look at it. Thank you.
Thank you so much. Thank you so much, everyone. So we are literally at 11:30, and I just want to invite Michael just to give us what next. So I know this is part 2, so we have part 3 coming up next week on the 21st, same time, same place. So maybe Michael, just a highlight of what to expect next week as we close up this series.
Thank you very much, Wendy. So we've talked about what is required. So we want you to, as we get into the next session, we want to see, can we have a checklist? And the last question also speaks to that. Can we have a checklist of all the things that are required, packaged in a way that is presentable to you, and which expert you actually need and when, and the kind of disciplines that you need to put in place so that by the time you're having the conversation, you are able to access credit. And I know we've relied heavily on lending, but also in that session, we understand and we appreciate that there are some people who want to look for alternative financing. So which avenues are open to you if you're looking for alternative financing? And here we'll be privileged to have our investment expert who will now walk us through what is on the other side of the coin. There's the lending aspect, and then there's from alternative funding. What is there for you? But I would like to urge each and every one of you, if your records are not in place, there are different experts who have spoken and they've explained in great detail what is required. So kindly get in touch with each and every one of us, and let's see, how can we move the 67% who do not have the records, or who feel that they want to have the conversation in the next couple of months? How do we move you to that place where you can confidently walk into a financial institution and present your business in a way that the bank can understand it and advance credit to it? So thank you very much, everyone who came, who listened to us for the last 1.5 hours, who engaged with us. I hope we can keep the conversation going through the contacts. Back to you, Wendy.
Thank you so much. Thank you so much, Michael. And I'm seeing a lot of requests for the session 1 recording. So please, it will be shared on emails. If you'd like the recording, please drop your email address in the chat, just that I'm able to pick it up and able to actually share it with you. We'll share the recording for session 1 and session 2 as well, just that you can go do your homework and revision before session 3 next week. I can see Thomas's hand is up. Thomas, anything else to add?
No, Eddie. Nothing else to add.
Okay, so if you'd still like the recording for session 1 and session 1, please let us know in the chat. We'll be happy to send it to you. The recording for session 2 will be available in the next 24 hours for you to actually recap and revise and ask questions. You can